Good morning.
Good morning, Andrew. Oh, James, sorry.
It's fair enough, don't worry.
Gonna get very
Um,
confusing.
Easily confused. Yeah, so you've given us a presentation. I'm going to let you take over the running for a bit. So do you want to introduce us to the City of London Trust, please? And then we'll get to some questions.
Absolutely. So I'll run through the presentation for about 15 minutes and then obviously open it to questions. So if we can move on to the next slide, which gives you some of the background of the trust. So we actually it was originally a brewery company. In that picture you can see is the old brewery on the banks of the Thames by Lower Thames Street, near where Cannon Street Station is now. It closed down in the 1930s and we became an investment trust at that point. We still own pubs until the early 1960s. It's always, in contrast to some of the trusts talked about earlier, it's always had a very independent board of directors. As Laurie Magnus as the chairman since 2020. The objective is to grow income and capital over the long term with a particularly emphasis on dividend income. About 2 billion, slightly over 2 billion of net assets. We've issued a lot of shares over the years at a small premium, but more recently, when we got to a discount of 2 to 3%, we bought back some shares in the first half of the year, around 35 million pounds worth. And we're very well known for the longest record of annual dividend increase of any investment trusts. And I'll go into that in a bit more detail. So next slide, please. We make use of some of the structural benefits of investment trusts with revenue reserves, issuing, buying back shares and gearing. And I'll talk more about that coming up. Next slide. So I've been manager of the fund since 1991. So it's a huge honor. 33 years as manager. And I've worked with David Smith for over 10 years and he was appointed deputy in 2021. We have a very competitive management fee at 0.3% of assets. Given the growth of the trust size, it was actually negotiated downwards by the board at the beginning of this year, for it was previously 0.325. So the ongoing charge, which is 0.37, which is already the lowest in our sector, we expect to go down when the new management fee rate kicks in over the full 12-month period. And we've issued some very cheap long-term debt. We took advantage of the period when interest rates were ultra low. And so we issued a £30 million private placement note going out to 2046 at 2.67% annual interest and a £50 million one at 2.94% annual interest going out to 2049. So we've really secured really cheap borrowings for our shareholders for investment in equities for the next quarter of a century. And obviously this is way cheaper than the government can now borrow at. Next slide. So in terms of my investment philosophy, I won't go into huge detail, but it is valuation driven. I really look at the share price valuations and equate them to the company's prospects. And dividend yield is the single most important factor, but I want to be in the companies that can grow their dividends and profits over the long term. So they need to be investing enough for the future and not overpaying on their dividends. I want to avoid the high yield value traps. And then I'm a pretty conservative personality, and that's reflected in the portfolio. And we like companies with good cash generation, are best able to pay their dividends and invest enough for the future. And we also like strong balance sheets, we particularly for cyclical companies. Next slide. So when I talk a bit about the performance, so the chart shows the performance since I became manager in 1991, 33 years, and we're well ahead of the index over that time, as you can see. The table below looks at the more performance over the 1, 3, 5, and 10 years, and we're ahead of the index over 1, 3, 5, and 10 years against our investment trust sector. We are ahead over 1, 3, and 5. We're very marginally behind, rather annoyingly, over 10. We're 91.1. The sector average is 92.7, but we're well ahead of the UK equity income OIC sector over 1, 3, 5, and 10 years. Next slide. And this chart is what our compliance was very keen to show you the discrete performance of the 12-month periods. Next slide. So this is the revenue. So how have we achieved this dividend growth every year going back to 1966? Well, the earnings per share don't actually go up every year. And if you look back over the last 5 years, I mean, we don't actually have if you look at the year to 30, we're June year end. If you look at the year to 30th of June 2020, actually the earnings per share were down. That was the year when COVID hit and we had all those dividend cuts. I mean, FTSE 100 dividends went down by 36%. It was worse outside the FTSE. and our earnings per share were down, but we still grew our dividend that year. And how we managed that was we paid out reserves. So we built the reserves up over the years, and we paid out 21%, which is the most we've ever paid out in reserves in my whole 3 years as manager. And the next year there was a recovery. Earnings per share got up to 17.09, but we still needed the reserves, 11.8%. And the last 3 years we've covered the dividend again. So the payout ratio, for example, the year that we've just reported, the 3rd of June 24, was 98.7. So we put 1.3% back into our revenue reserve. So looking at that year, the dividend was up 2.5%, which was slightly ahead of inflation, which was down to about 2.1% for the 12 months. Obviously in 23 and 22, we didn't beat inflation for our annual increase when inflation spiked up to 10% plus. But we look at it, the board is keen to beat inflation over the economic cycle, which say is a 10-year period. And over 10 years, our dividends up about 40% compared to 33% for the CPI. Next slide. So this gives you the whole history of the dividend going back to 1966, shows you how it compounds up. And then the chart on the right, the pie chart, is quite interesting. Just shows you the spread we have. So it's classic. We don't have all our eggs in one basket. We've got certain biases like consumer staples at 18% of the income, which is fairly solid. Banks has grown a bit with the growth in dividends from banks. That's up to 14%. Next slide. So I'll talk a bit about how I'm seeing the market and the positioning. Got two charts here. The first one is the PE of the market and measures a share price with earnings per share or kind of profits per share. And it's really bang on the very long-term average. So on this basis, market's kind of neither cheap nor expensive. This chart goes back over 20 years. In terms of yields, so we got the FTSE All-Share yield, but we're also comparing it with base rates, 10-year gilts and 30-year gilts. And actually, we've now got a situation where equity yields are yielding less than you can get on base rate or 10 and 30-year gilts. But this is nothing unusual. What was unusual really was the period since the financial crisis when equities have yielded more than fixed interest. For most of my career, equities have yielded less for very good reason. You get growth in dividends over the long run. So you would expect equities to yield less. So I'm not too bothered by that. In terms of where I am on, I have felt for time that inflation, where it's back at target, fact, slightly below, the latest print was 1.7%. But I think, we have got quite sticky wage growth. And in particular, we've had some big public sector wage increases with no productivity benefits. The minimum wage being put up another 6.7%. So I think I've been in the camp that, interest rates are coming down, but I've felt that they're going to come down more slowly than many in the market were expecting. And certainly the budget yesterday, it's a lot big addition to public spending. I think 70 billion per annum, and that has put pressure on the gilt market. So I think the Bank of England is going to probably be quite, we'll probably see one cut this year, but it's going to be tread quite cautiously would be my view. And I think the other factor globally is really just geopolitical tensions with the war in Ukraine carrying on. War in the Middle East and tensions with China. So our gearing's quite low at the moment. It's down about 5.4%. Our kind of fixed rate borrowings are fully invested, but our borrowing facilities pretty well unutilized at the moment. But I would say with UK equities, you are paid to hold on. It's a very attractive dividend yield, mixed dividend yield growth, and we're seeing lots of takeovers in the market. Last year we had Wincanton and Roundhill Music, which both got taken over. We've also got Britvic and DS Smith, which have been bid for. So we're seeing plenty of action in our portfolio and across the market generally. Next slide. So this just talks a little bit about the structure of the portfolio and how it's evolved. And we're down to about 82 holdings. We've got a slightly longer list than some funds, but we are a portfolio of over 2 billion. And having the smaller holdings gives me exposure to sort of some of the mid-cap stocks, which might be tricky in terms of liquidity otherwise. We're predominantly in FTSE 100. One trend is we've moved away a bit from overseas listed stocks, where just because the valuations are so much cheaper in the UK. So we were like 17% in overseas listed back in 2022, and we're down to about 9% at the moment. One sector where we've added a bit has been banks, where particularly NatWest, we've doubled our holding in NatWest at the beginning of this year, which has worked well. And we've now moved overweight banks for the first time in over 20 years. And I think one of the key factors here is what's called the structural hedge, and that banks your kind of deposits, they hedge out on a kind of rolling basis. So they have got hedges which they took out during a period of ultra low interest rates, which when they mature, they can re-hedge at much more attractive rates that you can get now. And this was a positive tailwind for bank profits as we see it. So we quite like the banking sector. Second biggest sector is what's called investment banking and brokerage. It's a kind of American term, but actually should really be called financial services. And we got some decent holdings here, M&G, mixture of fund manager and life insurer. IG Group's also got 3i in this sector, which has been a very good performer for us. We've actually reduced our holding recently, but it's because it's done so well, but it's that's included in this sector. And then the third biggest sector is personal care, drug and grocery stores. So Unilever's our biggest holding, but we've also got Tesco's, which has done well. Oil, we are underweight, but we have got a decent holding in Shell, also hold BP and Total, the French oil company. And in pharmaceuticals, we're underweight. We've got AstraZeneca. It's always a difficult stock for a UK income fund manager to have a full weighting in, but we've done well in Merck of the US and Johnson & Johnson and Novartis, as well as smaller holding in GSK. Next slide. And I think this is a really important slide because obviously we are known as a UK equity income fund. That's what we'll always be. But if you drill down into the companies we invest in, they are quite predominantly global companies. And we've looked at the whole portfolio and drilled down. And some 63% of the revenue in the portfolio comes from outside the UK. So almost approaching 2/3 of the revenue. And you see a good spread with North America, there, Europe, ex-UK, Asia Pacific, and emerging markets. Next slide. So to finish off, it's 50 years of annual dividend increase, which is the longest record of any investment trust. In fact, it's longer than any UK quoted company that I know of. There are some in America with longer records, like Johnson & Johnson, which we hold. As I said, the revenue reserves have been absolutely critical. We couldn't have achieved it as an open-ended fund. There have been some years we'd have had to cut our distribution, but obviously we've also got a core of consistent companies, and that's been a big factor as well. Charges are very competitive, the lowest in our sector, and with the lower management fee rate from the 1st of January, that should be heading downwards over the next 12 months. And we've achieved a long-term outperformance of the FTSE All-Share for a conservative investment style. So thank you very much for listening. I'd be very happy to take questions.
Thank you very much indeed. Yeah, very interesting. Just a couple of questions then. So let's start with sort of structural stuff. What drives the gearing level then? Is it cheap stocks or your view of where markets are going, or?
I think my whole approach is really kind of bottom up and led by the stocks, and it's where I can buy into stocks with attractive dividend yields and good other valuation characteristics. I'm kind of willing to overlook the kind of noise of the short-term noise of the market to an extent. But we do, I don't ignore the macro factors, and certainly at the board meeting we have 8 board meetings a year, and we look at some kind of key valuation measures for the UK market and borrowing costs, etc. So it's something it's discussed with the board, and I have some discretion on the gearing between meetings as well. So we don't ignore the macro side of things. And if the market had a sort of big correction, that would obviously immediately we'd be interested because the market would be cheaper, but also all of our stocks would be cheaper. So we would that would kind of trigger interest. So I think it's predominantly bottom up, but it also with some macro overlay as well.
With the overseas holdings, is there an element of getting access to sectors that you wouldn't otherwise get hold of, or is it about sort of best in class?
Yes, certainly, we bought Microsoft back in like 2013, and we held it for over 10 years, and about 10 years, and it performed incredibly well. It went up 10 times, and that was a classic example of having access to a stock we couldn't kind of really find in the UK. I think also in certain sectors it gives you a bit of diversification. Particularly the oil sector. When Shell cut its dividend in 2020, I actually switched some into Total, the French company, which didn't cut its dividend, and it's done well. Shell's recovered as well, but I didn't. I sold about 1/3 of Shell holdings, so we still got Shell, and but by having some Total, that sort of meant I didn't lose out from recovery in the oil price and the sector generally, while still getting decent yield. And in pharmaceuticals, rather than just AstraZeneca and GSK or Glaxo, we've had some interesting stocks in the US. And actually, AstraZeneca's, a very good company, been very successful discovering new drugs, but its valuation isn't particularly cheap relative to what you can find overseas. So that's a good example of, so we've done what, Astra's done well, but we've benefited in the stocks we've held. And then, we've seen one or two value opportunities. We've got Swire Pacific, which is our only Hong Kong stocks listed in Hong Kong. It's actually controlled by a British family, and it's a very interesting stock. It owns 83% of Swire Properties, and which is quoted in the Hong Kong Exchange, and also 45% of Cathay Pacific, the airline. And if you add the value of those stakes and the rest of Swire Pacific's in the price for nothing, and that includes the biggest Coca-Cola bottler in the Pacific region. So it's kind of a family-controlled stock. So people, it's not in the, I don't think it's in the Hang Seng Index for some obscure reasons, but it's sort of so it's kind of off a lot of people's radar screen. But I think it's a real kind of value stock for so we're always out interested in, and it's conservatively run, low debt, etc. So it's kind of it's an interesting way to play the sort of Hong Kong and Asia Pacific markets. Our only stock out there, by the way.
Okay, great, thank you. Because you've got to get the yield target. I mean, you got to make sure you earn enough to cover the dividend. Does that mean you'll never hold anything that's not got a yield?
Yes, I mean sometimes you get a kind of a company suspending the dividend, and you wouldn't just immediately sell it because it could be the worst possible moment. And we've got something called XP Power, very small holding, and they've stopped paying a dividend. But actually, I hung on to that one. It would be difficult to have been a big holding, and they did get a bid approach actually earlier in the year as well, which they've rejected. And I think that one will eventually recover. But I think in general, I wouldn't sort of be buying anything on a dividend yield less than 2%. I mean, we've got some big holders. I mean, Relics has been one of our best holdings. I think at the end of September, it was our second biggest or third biggest holding. It's right up there, and that only yields 1.7%. But I've believe in that stock, and think it's one of the best stocks in the UK market in terms of the quality of its business. But then we can balance that by also in our top 10 we've got British American Tobacco, which yields kind of 9. And so people sometimes complain, why do you hold BATS and Imperial Group? Well, we've got those ones to provide the kind of dividend income, which is really important and allows us to have exposure to lower yield. So overall, the portfolio's got a tilt in terms of its yield above average market. It kind of, usually it's between about 20% to 30% more than the index yield. But within that, we can hold some low yielders as we do. Difficult though to have. I mean, I tend to rule out non-dividend paying stocks. I wouldn't contemplate buying a non-dividend paying stock, to be honest. And you wouldn't see me buying anything yielding less than 2. I mean, adding to anything that I already got. But we can run our winners. So, and as we do when we think they're really good quality companies.
You mentioned the tobacco stocks there. There's a specific question here about how you look at the prospects of those relative to the regulatory pressures that they face. What's your view on those going forward?
Well, I think they've got two interesting strategies. I mean, BAT is kind of investing quite heavily in less harmful products and is the leader in vaping in the US. But they've got a issue in the sense that there's kind of lots of semi-legal disposable Chinese vapes which are eating away their share at the moment. But Imperial's kind of more focused on kind of share buybacks. It's got less debt, and it's actually performed better. So I mean, I think the kind of existing business of cigarettes is still very profitable for both companies, and it does free off a lot of cash. And so I think I mean, I got no ultimately the cigarette smoking will end at some point, hopefully. But I think there's quite a long runway, and in the meantime, I mean, Imperial has been buying back its shares for 18 months and has bought back around approaching 10% of its equity in that period. And so at the same time, it can been growing its dividend by 4%. So the actual cost of the dividend for the company is going down because it's reducing its share count so rapidly. So when you're incredibly cheaply rated as these companies are, it is very advantageous to buy in your shares, for the existing shareholders. And, people have talked about the Conservatives brought in this idea that people, I think born in 2009, will never be allowed to buy us cigarettes in the UK, and Labour are going to do the same thing. And so going forward, but I think curiously, they're not going to be banned from smoking itself, but they're just going to be banned from buying cigarettes. But in any case, the way Imperial Brands is going, by the time this really kicks into action, I don't think there'll be any shares left. Because if they're buying 10% every 18 months, it's going to sort of so I'm not too worried about it, to be honest.
Fair enough. Banks have got a new problem in face of this the car finance commissions. Is that something that might affect the portfolio?
Um, yeah, it affects Lloyd's in particular. Barclays, NatWest has no exposure, hasn't been doing car finance. Barclays got very modest exposure. It's not a factor for HSBC either. So those are the four I hold. But it has got, certainly this judgment, if it has got implications for all commission, including, whole, not just car finance. So, I think there are, it could have it's already might well be having an effect on people buying cars. And if you could, in the sense a lot of people have withdrawn. Lloyd's are still offering car finance, but several of the people previously have actually halted offering it. So I think there needs to be some sort of urgent discussions. I'm sure there are going on with the authorities, because I think it could have some kind of unintended consequences, this ruling, and leading to real impact on the economy. So Lloyd's is the only one of the four banks I've got which has got a material exposure, but I think the share price has reacted negatively to last Friday's court judgment. I'm not planning to take any action at these levels on the shares, but obviously it's something we're watching closely as events unfold. There will be a appeal to the Supreme Court, so that'll be interesting to see, what happens with that. That may not. That could take a few months for any verdict on that to come through. And in the meantime, see what kind of the FCA comes out with in terms of how they're reading it. Certainly Sir Howard Davis, previously a very senior regulator, he was a bit critical of some of the FCA's wording in his testimony to House of Lords a couple of days ago.
Thank you. There's a question here about AstraZeneca. Actually, I'll just slightly turn it around. So the question is really saying is, why do you hold an underweight position? I think I'll turn it around and say, do you think about the weightings in the all share when you're deciding on the shape of the portfolio? Was that something that you do?
I think a bit about it, but it's not something, because obviously we're measured against the FTSE All Share to some extent. On the other hand, our objective is to grow shareholders' income and capital. I think it's I've seen it so many times. My time as a fund manager, it's a great danger to be, great mistake to be too influenced by weightings in the index. You sometimes have to ignore them entirely. But it's, I don't have problems with underweight positions. AstraZeneca is a very good company. It's been right at the forefront of the immunotherapy area of cancer. Merck, which we've also got, has also is also in fact is the leader in that area. But AstraZeneca's done incredibly well, discovering new drugs. I'm very proud to have a holding. It's in the top 10 actually, but it's just a very big index stock, and it's and I just can't get anywhere near a market weighting in it. It's kind of like 7 in the index or something like that, and it's a very low yield. It's only 2%, so it's just not something I can really get anywhere close to in terms of. But I'm happy to sort of have some, and that's just how it is really. But I kind of make up some of the underweight through some of the overseas listed stocks I've got, which have got slightly better yields.
There's a question here about TP ICAP.
Yes,
What was the attraction of it, please?
that's a recent purchase, and it's really I think its income. It's a 6% yield, twice covered. It's an intermediary between investment banks in the money markets. Is his main business, which is quite a low growth business, but it is very cash generative. And I think it had a difficult time when they merged. The two businesses, it was two companies, and it merged, and I think the market got a bit ahead of itself in terms of cost savings, and they did actually have to cut the dividend at one point, but they've restored the dividend, and I've recently bought it, and just really as a, I'm not expecting huge things from it, but it is attractive yield, and who knows, I bought it on a yield slightly more than 6, maybe it gets down to 5% dividend yield, a safe yield, and you get some pretty useful upside, capital upside, if it does manage to do that. But it, certainly is, as an income stock, it looks quite attractive to me.
We haven't asked the big question, which is Andrew mentioned already, which is what do you think about the budget, and will that make a difference to anything that you've got in the fund?
Yeah, I mean, it's obviously huge amount of spending. I mean, she's changed the sort of rules a bit, so she can spend more, and so 70 billion extra public spending per annum, and obviously raising taxes by 40 billion, of which 25 billion is coming from employers' national insurance. So it's not good for big employers. I mean, one area, retailers, and we're though we've got a big holding in Tesco's, we're kind of underweight retailers generally, and they'll certainly be affected by both the national insurance increase for employers, and also by the minimum wage. Even if they don't have people on the minimum wage, it will affect, put pressure on wages at the sort of lower end of the structure. So I think the gilt market yesterday was worrying that whether the tax increase will come through. There was some skepticism that whether she will raise the 40 billion from what she's outlined, and so the view is that she might have to raise taxes again or borrow more, and I think that's what put the jitters on gilts yesterday. So it's interesting. I mean, I'm just, I do worry slightly that all this public spending, whether it really improves productivity and growth in the economy. I mean, I'm a bit skeptical on that myself, but hopefully it will do. And we all want the government to succeed, for the sake of the country. And but I think certainly the OBR growth forecasts were pretty lackluster going forward. I thought, and it would look at kind of growth of below 2% per annum, as I remember. And if that's all we're going to get, I mean, that certainly won't. That'll be disappointing compared to what they've set out to do in their manifesto. And so I'm sure that Rachel Reeves and the government will want to do better than that, but that's what the OBR were forecasting yesterday.
Yeah, I think I agree with you there. The growth figures did look a bit unexciting. And do you have any exposure to the sort of hospitality leisure type sectors that are also going to be affected by national insurance?
No, we're very low in that actually. The only leisure stock, we've got a tiny holding in Young's, the pub group, and that's really a property play. We quite like held them for a very long time, and we like the freehold pubs they own. Just the property value's got some, I think, got a it's interesting longer term value play, but it's a tiny holding. It's one of the smallest holdings in the portfolio, so we've almost got no exposure to hospitality and leisure. But they will certainly be they're a definite loser with the as a big employer, unfortunately.
Yeah. Actually, we didn't ask the question about the small cap stuff. So, in terms of most of the portfolios, obviously in the FTSE 100, how low can you go into as a market cap?
There's no rule, but I think just liquidity being what it is, it's quite difficult if I'm to buy a small cap stock. I mean, Young's is a fairly small market cap. I can't remember exactly, but it's kind of sub 500 million, and I bought that when Guinness Peat, the New Zealand fund manager many years ago, they had a big stake, and they had to change strategy, and they placed it, and we took some stock there, and that's how you can get in a sort of with a kind of very small cap stock. So I don't have any rules, but I think just practically speaking, I mean, for us, our funds net assets are like 2.1 billion or something, roughly. So a 0.5% position is kind of 10 million pounds plus, and you try and do that in small cap stocks, it's just virtually impossible. So but certainly the mid cap is, you have to be a bit patient sometimes accumulating stake in a mid cap stock, but it is kind of that's kind of feasible from our point of view. But but we sometimes do. I mean, we had a big success in Roundhill Music, the royalties, which I bought in June of 2023, and there was a big seller around. I don't know who it was, but he would be regretting it because actually they got bid for very quickly, which I wasn't anticipating. But we had a very nice uplift, but we were able to buy was quite a small company, and we were able to buy. I think we bought £10 million stake in that one quite easily. And so if there's a seller around, it is possible. But in the normal course of events, it's quite tricky to just practically build up a stake for us.
And then finally, sort of in the big picture thing, are you sort of trying to grow the dividend in line with inflation every year, or is that sort of a longer term ambition?
Yeah, it's longer term. We can't do it every. I mean, like the previous year when inflation went up to over 10%. I mean, and it was a time when market dividend growth was kind of like mid-single digit or something. It's just it would have been really difficult. But as I said, the board's objective is to grow the dividend over the course of the economic cycle. So that's 10 years when you've got different market conditions, and that we have achieved. And so we haven't done it every single year, but we have achieved it over the course of the economic cycle, and that's definitely our ambition, is to carry on doing that. And of course, we have grown it in nominal terms every year since 1966, I should hasten to add.
Exactly. So it's a fantastic track record. Thank you very much indeed for this morning, Joe. I think
It's a
we've
pleasure.
answered everybody's questions. By all means, send in any more if you want to, and we'll try and get them answered. But thank you for your time this morning, and we'll get you back again in a year or so and see how things are going.
Very good. Thank you very much.
Next week, we'll be back. Matt will be talking to CQS New City High Yield. I will be at the Money Week Wealth Summit, which is in the city. And I've been asked to remind you about this. And if you want to attend, there's a link on our website that will take you to it. The week after, I'll be back talking to Sebastian Lyon for personal assets. So thank you very much for your time this morning. As always, if you haven't voted yet, we're very keen to know what you think should be the winners in each of our categories in our Investors' Choice Awards. Have a good weekend, and we'll talk to you next week.